You would think a legacy metal bending company has absolutely nothing to do with the AI boom, but apparently their liquid cooling tanks are the exact thing keeping data centers from literally melting down right now. Welcome to Earnings Unscripted. It is March 25th, 2026, and today we are tearing into the Q3 results for Worthington Enterprises, ticker WOR. I mean, Miro, seeing a heavy industrial manufacturer put up tech-like growth numbers is just wild.
Yeah, it is definitely not what you expect when the core legacy business is steel roof clips and gas cylinders. The optics here are staggering on the surface, but you always have to peel back how they actually bought that growth.
For sure, but just setting the table first. Net sales hit $378.7 million. That's a 15.6% jump from last quarter. Operating income went up a massive 156% to $31.5 million, and diluted EPS came in at 92 cents. Oh, and quick disclaimer before we unpack all of that. We are just two friends sharing personal opinions here, so this is definitely not financial advice. Please do not go panic buying industrial helium on our account. But okay, Miro, 156% operating jump. Where is that even coming from?
It is massive, though you have to look at the anatomy of that jump. The data center cooling tanks are a great narrative. They expect that volume to triple this year. But the actual immediate weight pulling the wagon is consumer goods, specifically party balloons.
Wait, party balloons? You are serious?
Entirely serious. Their balloon time kits just expanded into 55,000 retail stores. That massive shelf placement alone drove consumer EBITDA up over 130% sequentially. So you take that and combine it with a $205 million mid-quarter acquisition of LSI Group, that directly injected a ton of volume into their building product segment.
Right, which explains the big revenue pop, but clearly the market was incredibly confused by it today because the stock action was just completely bipolar.
Bipolar is the right word. The stock tanked immediately after the morning call, dragging all the way down below $46 intraday. Then someone clearly took a breath, looked at the actual cash generation, and realized the corp business is fine. It staged this brutal V-shaped recovery all afternoon and closed at $49.51, so down only about 1.6%.
It feels like investors saw the headline growth, got super excited, then looked at the cash balance and just panicked because that LSI acquisition you mentioned basically zeroed out their bank account.
Drained is a better word. They dropped from roughly $180 million in cash down to $6 million. $6 million in cash for a business running a $378 million quarterly top line. They are basically running the thermal budget at red line right now.
That makes me so nervous, especially since the CEO was talking about how bad winter storms completely froze out some of their manufacturing days this quarter. Unpredictable things just happen.
They do, but to be fair, those exact same blizzards caused a massive run on their consumer camping gas and emergency heaters, so they accidentally hedge their own weather risk. But I'm honestly looking much closer at how they define their new profit margins. There is some very creative math happening with this LSI integration.
Okay, well, that's a perfect tease. Let's get into the details and actually look under the hood.
Right. So let us look under the hood. You buy a massive commercial roofing company like LSI, you inherit all this acquired inventory. Normally, when you sell that inventory, well, actually, the accounting rules force you to recognize it at a stepped-up fair value the moment you acquire it. It hits your cost of goods sold and temporarily drags down your margins.
Which is painful if you are trying to show Wall Street how perfectly your shiny new acquisition is performing.
Exactly. So what Worthington did this quarter is just quietly alter their definition of non-GAAP metrics. They explicitly stripped out the amortization of those inventory step-up charges for both adjusted EPS and adjusted EBITDA. They even published a whole table recasting their fiscal 24 and 25 numbers just to make the quarter-over-quarter comps look perfectly smooth.
That is so incredibly convenient. Wait, so are they hiding poor performance, or is that actually a legitimate way to present the core business?
I mean, it is not completely uncommon. It is perfectly legal. But doing it right after draining the bank account to buy LSI and Elgin, it just creates a very nice, very timely cushion for their adjusted margins while they integrate the operations.
It makes you wonder how confident they really are about their underlying profitability right now, because I know the CFO, Colin Souza, I think he basically blurted out a new gross margin target during the Q&A. He said something about wanting to hit 30%.
He did. Gross margin landed at 28.9% this quarter, and Sousa said, quote, "We are trying to get to 30%, and we have been in the high 20s over the past couple quarters to make progress toward that range. So now the market has a ceiling to watch."
But there is a huge caveat to those margins, right? Because they're also getting a nice little artificial moat from geopolitical trade policies. The CEO, Joe Haig, flat out admitted they're benefiting from Section 232 tariffs.
Oh, yeah, because for several specific value streams, they are literally the only domestic manufacturer left. So those tariffs essentially form a protective wall against cheap foreign dumping. Most companies complain about tariffs inflating their input costs. Worthington is basically sitting there thanking Washington for the pricing power.
It is brilliant if you are the one holding the cards. But speaking of the CFO and setting targets, we have to talk about the guidance discrepancy, because this is honestly the wildest thing I saw in the entire research file.
The bot hallucination. Yeah, you have to explain this to people because it is peak 2026 market structure.
Right. So if you pull up the aggregated financial newswires or look at the summary literally appended to their own transcript document, there are these external reports claiming Worthington provided positive forward guidance, specifically an EPS forecast of $1.15 for Q4. But Miro, they did not actually say that anywhere.
No, they did the exact opposite. An analyst tried to pin them down on the call, and Colin Sousa completely shut him down. His exact response was, "Yeah, that sounds suspiciously like giving guidance, Will. We are not going to be able to do that."
I love that response. But it is actually terrifying. We have automated analyst models and third-party news scrapers just injecting fake forward-looking numbers into the public domain. And these numbers are getting attached to the official earnings material.
It is entropy with better marketing. You have trading algos reading summaries written by other algos and pricing in a $1.15 EPS that management explicitly refused to give. I mean, it's funny until someone loses a few $100 million trading on a hallucinated metric.
Exactly. And the real guidance they did give was entirely qualitative, just a steady as she goes narrative, which honestly feels a bit fragile when you realize they completely halted European LPG shipments to the Middle East this quarter because of the supply chain risks in the Red Sea.
True, though they claim the U.S. exposure offsets that geopolitical gap. But you're right, Susie, between the Middle East supply halts, the weirdly aggressive adjusted accounting, and external bots making up their targets, there are a lot of moving parts hiding under the surface of this beat.
So where does this leave them heading into next quarter? Because it feels like they're walking a very strange tightrope right now.
Yeah, it is exactly a tightrope. Look, they are essentially betting the next quarter on pure execution. They have $6 million in cash left, so the immediate outlook is just aggressively rebuilding that balance sheet. I would be surprised if, well, they only bought back about $5 million in stock this quarter anyway, so I expect buybacks to stay basically frozen while free cash flow catches up.
Right, which is just basic capital discipline. It feels like a digestion phase. You buy a $200 million company, you kind of need to take a breath. But looking forward, how much is the macro environment actually going to drag on them?
That is the big unknown right now. Their commercial real estate joint venture, Clark Dietrich, is absolutely feeling the weight of high interest rates. Management flat out said Q4 is going to be relatively flattish for that segment.
Okay, so traditional commercial construction is stalling out. But then they have that liquid cooling data center boom completely carrying the load.
Exactly. And that is the underlying thesis here. They're quietly transitioning from a legacy building materials supplier into an AI infrastructure play. Even the CEO, Joe Hayek, was pretty grounded about the whole thing. He noted demand is steady and likely to continue this way unless something unforeseen happens. And he literally added, look, there's a lot going on in the world.
which is the ultimate CEO hedge for please do not blame us if the global economy breaks next month.
It is honest, though. I prefer that over blind optimism.
Absolutely. It's just a fascinating pivot to watch, going from bending metal and filling party balloons to cooling down supercomputers. We'll definitely keep an eye on how quickly they can refill that bank account.
Assuming they don't accidentally buy another massive company next Tuesday.
Let's give them at least until Wednesday. All right, that does it for our look at Worthington. Thanks for thinking out loud with us today, and we'll catch you after the next print. Also, if you want these earnings teardowns to just quietly show up in your feed, feel free to follow the podcast. Just a quick reminder that we use AI to help generate these chats, but every single number we mention is strictly pulled from actual corporate filings to keep things grounded. We really enjoy hearing from you, so if there's a ticker you want us to dig into next, just drop a note to earningsunscripted@datamadness.ca or grab the X link in the show notes.
See you next time.